transparent platform for investors and exporters to exchange currency, and that has also buoyed the market. We saw about $3.8 billion as exchange in that market alone. Although the CBN hasn't really done what we expect them to do, which is a full convergence of the currency, we still have something like 6 to 7 different official rates from the, the
IOC's window.
The IOC window for import of PMS to the central bank official rate, the interbank rate, the NAFEX rate, the Form M and Form A people. And there's probably going to be a rate for, people going on Hajj, which is coming up soon. So this is not helpful to the economy. I think that, if we move towards an environment of full convergence, that will again be another signal of, positive adjustment of the economy to sort of real market prices. So all of that has been beneficial. With the introduction of the I&E window in April, the market has surged. If you recall, as of March, the NSE All Share Index was down minus 8.5% to the year. It's now up 23% year to date. That's a positive swing of over 31%. In fact, at a point it was up 25%. There's been some profit taking, but that has come back. And we expect to see more sort of people are thinking, oh gosh, has all the upside gone out of the market? I don't think so. Our belief is that as the half-year numbers begin to come out, we expect to see more fundamental results coming, and investors should be able to pick based on fundamentals. The best performing sectors still remain agriculture, which is up 65% year to date, banking 45%, industrial sectors about 21%. So there's still some choice stocks to pick within those universe.
In terms of economic fundamentals, and this is bringing me to the question, when people say, look, it looks like we're all tied to the apron of oil, whether in terms of production or in terms of price. But if we can discount these two and say, are we on serious macroeconomic fundamentals in terms of policies and policy actions, what would you say?
Well, to be honest, we have good plans. We're not very good in implementing anything. That's really the problem. I think where the central bank is quite close to sort of being able to sort of make a full adjustment on the currency side. Given where the oil prices are internationally and given where the exchange rate is, I believe the subsidy on oil on PMS is quite low. This is a great time for the government to consider removing the subsidy fully. That will also signal to real investors that they can come in and invest in the downstream side, which is something we've been arguing for years. So there are certain opportunities that are staring us in the face, which we are reluctant to take, either for non sort of monetary or fiscal policy reasons. There are also political, persuasions behind the scenes. So it's unfortunate that this is the case, but quite frankly, there's a time that you could say the country could be ready to start moving away from oil, but we do need to make certain critical reforms for that to start happening.
There are critical decisions to be taken. So let's put this to you straight. What do you consider today the fiscal position of the Buhari's administration? From the debt sustainability side of things, from borrowings, external and domestic borrowings, the debt servicing, these are serious variables. That would have very serious consequences.
Well, you're really, going towards the end where a corner which is really not a good point for the current government. You see, the 2016 budget was 6.1 trillion with a deficit built into it of 1.8 trillion naira. And they fell short of their own revenue target by about 18%, so they had to borrow more. Now, the 2017 budget is even more aggressive. It's a 7.4 trillion naira budget with a built-in deficit of 2.4 trillion naira. Now, the problem with that borrowing is that we're driving the country to a point where you will say that the debt is not sustainable. I mean, the DMO could argue that with only 15% debt to GDP, that Nigeria is not really that leveraged. But we have to look at it from the capacity to service the debt. In 2016, our debt service to revenue was 33%. In 2017, it's already trending to 66%. So that means for every 1 naira of revenue we make, we spend 66%, 6 kobo to service debt. That is not a sustainable direction to go. Clearly, the government is making efforts to increase and deepen tax revenue. There's a lot of reform coming out in the tax sector. But these will take some time before they trickle in. It may then be more sensible for the government to take a more conservative approach on the budget side by not taking a more, such a large deficit into the budget. And those are some of the constraints we'll see in the system, because by going to borrow, you see the government crowding out the real sector, and at the same time, interest rates are high, inflation is high, and then, of course, real companies cannot go and get money at a decent price. With FGM bonds, average yield about 16% now. If you as a corporate want to go and borrow, you have to put maybe 300-400 basis points on top of that. If you as an individual want to borrow, you're clearly in the north of 22, 23%. So that's quite expensive for, for the economy, for people to be able to get money, get liquidity.
From your C-suits position as an executive, you think we've got a bit of our fingers on the FX side of things.
Correct.
So at second half, the balance of 6 months of 2017, where we are now in the first month of that, what do you consider as the top risk elements for the good fortune that we've had in the first half?
The big risk factors remain oil prices and our own production volumes. We had always had a sort of special treatment at OPEC that allowed us to do as much as 2 or 2.2 million barrels per day. But there's current discussions about Nigeria being asked to reduce their own production to be in line with our allocation within the OPEC system. So clearly, we need all the production capacity we can get. So that's a risk factor that has not yet crystallized yet. There is inflation. Although inflation has ameliorated, from about 18% at the beginning of the year, is now about 16%. That's only reduced due to the base effect, because the inflation numbers were much higher last year. But we don't see that coming down. We're projecting maybe by the end of the year it could become to around 14 to 15%. But already we're seeing that food price inflation is trending upwards. It's a seasonal effect. And if that's not checked, it could mean that inflation could actually trend upwards by the end of the year.
Okay, we're going to take a break. When we come back, have this at the back of your mind. We're going to talk about the banking sector. You folks always release the annual banking report every year, so I'm going to ask you a few questions about that. We'll be right back. Ike Chioke, Group Managing Director at Afrinvest West Africa.